Hey guys, so today I want to talk to you about an ETF that I love. It's an S&P 500 index fund, and it's specifically from Vanguard. And this ETF, the ticker symbol for this ETF is VOO, VOO. And it's the Vanguard S&P 500 ETF. It's very simple. It matches the S&P 500 index itself. So they try to match it, or as actually it matches it. So it's just what the market is. Essentially, it's the market. And I'm going to do more videos on my thoughts of the S&P 500 index fund, what Warren Buffett says about it, and what most investors say about the index. And to me, it's one of the best investments you can make. And I'm going to explain to you a little bit why here. Just a couple things. I have it here screenshotted on my phone. If you can't see it, my phone's a little dirty, sorry about that. But it's the past 5 years, it's grown 82% approximately, right? And it's about 16% a year in the past 5 years. This is after we just went through 2020 as well. So imagine if 2020 wouldn't have happened, with a huge dip in March, it could have been even more, but that's the power of the market. That's the power of the US economy. That's the power of a diversified portfolio, essentially. That's what it is. If you don't know what the S&P 500 index or index funds are, is the top 500 US companies. So, I mean, just think about that for a second. You're investing in companies themselves, little shares of the company, of the 500 biggest companies. So right now, for example, the VOO is trading at $340 a share. So that $340 is essentially being spread out. Your risk is being spread out through those 500 companies. So you're holding an ETF that has 500 of the strongest. And what's great about that is they're always reviewing those 500 companies. For example, Tesla just got in, which is huge. And so it's always looking at how they're performing in the market. They have all these metrics that they use to see who deserves to be in the coveted 500 companies. So it's really based on market capitalization, which is just, the market tells us who's on the top, and that's through the market capitalization. But why do I love VOO specifically? Well, because there's S&P 500 index funds. There's Charles Schwab has them, Fidelity has them. Most companies have them now. But why do I like Vanguard? Well, Vanguard is known to have some of the smallest expense ratios. I believe here, VOO expense ratio is not on my app here. Let me see if it's in the stocks. No, it doesn't have the expense ratio, but it does. It's about 0.05%. Like the expense ratio for it is basically what you're paying for the ETFs management of the funds, which is not much. It's a lot of back office, paperwork type stuff. So you're paying 0.05 annual fees for this investment, which is nothing. If you look at some of these other high yielding mutual funds, which I have some, that are supposed to be beating the market, which not many do beat the market, which is the S&P 500 index fund essentially, their expense ratio is as high as 1%. I've seen some, and I'm not gonna mention the financial institution that just price gouges people, but they are what are these called? These MLM type things. You don't want to get involved with those. I mean, you can. I'm not going to hate on you, but the expense ratio on those are like 3 or 4%. That's ridiculous. So that's why I love Vanguard specifically, because their expense ratios are so low. They're the lowest that are out there, and it's not just the S&P 500 index ETF that they have. It's a lot of their funds that they have. The expense ratio is really low. And that matters because over time, if you're holding these investments or buying more of these over a long period of time in a 20, 30, 40, even 50 year time period, that expense ratio also compounds with your growth of your portfolio because 0.05% of $100,000 isn't as much as a $10 million portfolio. Now it starts to add up. So which effectively dips into your compounding increase. It's working against you. So if you've got 2 or 3% expense ratios working against you, I mean, you're instead of making 12%, you're only making what? 6, 7, 8%. It really does matter. And so that's why I love, one of the reasons why I love Vanguard specifically, but VOO especially, the expense ratio is really low. The other thing, it's again, I mentioned before, is diversified. It's one stock. You don't have to worry about picking like 500 individual stocks. I guess you can do that. I mean, if you have the time, if you have nothing else to do, you can go on Robinhood and buy, 3, 4, 500 stocks and hold a percentage of them. But that's just so much work that isn't necessary. That just pick the best 500 companies. You're completely diversified in that, and you're kind of not because it's a stock. But so you're just putting your money in the market. I've heard Mark Cuban and some others talk about diversification is horrible. Don't diversify. But they're specifically talking about diversifying in so many different businesses, not necessarily in the market. And if they are talking about the market, I think they have to do a better job explaining that because diversification is important. Diversification is a good thing. I think it's just over diversification. I can see how over diversification could just not make a lot of gains. When you start diversifying into gold, into US treasuries, when you're investing in bonds, you're going to reduce your return because those are giving you 1, 2, 3%. Money market accounts, you're reducing it down, and so that really pulls your investment portfolio down, especially if it's like a big chunk of your portfolio. If you have 80% in bonds and 20% in the market, like in an S&P 500 index fund, then yeah, you're gonna get like 3 or 4% returns. So I think that's what they're talking about. But lastly, what I love about Vanguard S&P 500 index funds, specifically VOO, is that you can continually buy those month over month over month, and that's what I do. I consistently buy them. They're as easy as trading a stock. I mean, they're very simple. It's not like a mutual fund where you have to save $2,000, $3,000, some $5,000. I've even seen some mutual funds where you have to get in at $10,000. I know when I first started years ago, that's all that was really available. Is like, okay, you need $10,000. And at the time, I was a 20-something year old. I didn't have $10,000 in the bank. I had to slowly grow my wealth, and I didn't want to put in my emergency fund. I did have some cash, but that was, I didn't want to like invest that in the market. And so mutual funds can be pricey as far as your entry point, but ETFs, specifically VOO, the Vanguard one, it's all you need is 300. Right now it's trading at 340. Save up $340, buy your first one. You're diversified, low expense ratio, and this is the real key. The returns are steady. It follows the market, and the market for the past 30 years have averaged 12%. In the past 5 years, like we mentioned earlier, was 16%. So it's a great return, and it's a safe return in my opinion. And so those are the reasons why I love VOO, and specifically through Vanguard and the Vanguard products, if you will. So that's all I have. Hopefully you found this informative. If you haven't subscribed, please subscribe. It's going to help me out tremendously. I'm trying to get to 100 subscribers in the next month or so, in the next couple months, so that would really help me out a lot. And if you like the video, please don't forget to smash the like button. I can't believe I did that, but smash the like button. It makes the lens blurry. That's all I have for you. See you next time.